Very importantly, this is another insight, is that changing leverage across your trades is bound to only fool you, because in that situation, you will fly blind. You can go into two types of errors. The first one could be that you have a bad strategy that ends up winning, not because it's good, but because you were lucky enough to take your high-risk trades and win. Or what's even worse, you might have a good strategy which ends up losing money because you happened to be unlucky in putting more risk on losers than you did on winners. And the conclusion to this is that there is more or less trade level consistent leverage that delivers your risk appetite. In other words, you should not place too much difference in the leverage you deploy across trades. I'm not saying you should always trade with exactly the same leverage, but there should be a small variation between leverage across trades. And this is the key to a risk management framework. Basically, on the one hand, you have your trees, your trades or positions, i.e. trades taking at the same time. And over time, you will take a sequence of those trades, and that is what your strategy is. And the tool that links this risk appetite statement of I will not lose more than, say, 10% of my equity more often than 1 month every 20 is, on the one hand, how many pips you're willing to risk on your trade or position. And more importantly, what percentage of your equity that is going to mean, which is a function of the trade level leverage that you have picked. And that is your ultimate, most important risk management tool. How much leverage you place on any individual trade or position. So to summarize, what is the framework? Well, the first framework is to ask yourself how much risk you actually want to take. Let's say you say, well, my risk appetite is I don't want to lose more than 10% of my equity one month every 20, more often than 1 month every 20. Given this is my risk appetite, and given the way I trade, how often I place my trades and how long I keep them open, I will have a strategy to open my trades with my personal trade leverage. Say, I will always place my trades with a leverage of 1-to-1 or 5-to-1 or 10-to-1. And this leverage will be individual to me because it is I who determines how often I trade, what assets I trade, and when I trade. And depending on that, I will have to adjust the leverage. And when the trades are live, I will need the discipline to program a stop loss, or very importantly, a take profit. When my setup has played out, I should basically say, well, either this trade has worked or it hasn't worked. And then I simply have the discipline to close it regardless of whether I'm winning or losing if my time is up. So if you go into a trade for a couple of hours, and after those couple of hours, you have neither hit your take profit nor your stop loss, ideally, you should really have the discipline to close that trade wherever it is, because just leaving it randomly open is basically taking a random path. It's no longer a strategy. To sum it up, sound risk management is taken on a trade-by-trade basis. You do this on a bottom-up basis by taking every trade with the same leverage and working on your strategy to make sure that you gear it up to profits, not by taking more leverage across trades, but by making sure that the percentage of trades that end up winning goes up, or at least that the profit you make when you win is higher than what you lose when you lose. Of course, you're probably asking yourself, well, I don't really have a fully defined strategy yet. Well, if you don't, that's okay. No one has a strategy when they start out, and it takes time. The simplest way to work in that situation is to just pick a low leverage that you feel very comfortable with and always trade with that trade level leverage. The other one is, of course, you will probably not know what that trade level risk amounts to on a strategy level. So if I take my trades with 2% equity risk per trade, how much could I end up losing after 1 full month of trading? Well, don't worry, because I'm going to give you the answer to that. You don't need to work it out for yourself. There are tools for that. Similarly, if you take several trades at the same time, for instance, what people call position trading, say you go long in the pound yen and you go short in the euro dollar at the same time, obviously nominal leverage will not work because the risk could go, well, it's difficult to work it out from the nominal leverage, but there's no problem because there are also tools to tell you exactly how much trade level risk you're taking. And of course, there's no way to link, just without doing some calculations, the strategy level risk appetite. I don't want to lose more than 20% in a month, with the leverage that you have to take on every individual trade given your strategy. And that is the reason why we offer a toolkit to work those questions out. So the reason we do that is because we are a peer-to-peer asset manager, which is looking for good traders. So we offer traders toolkits for diagnosing themselves and rating themselves with investors. And we allow investors to invest in the best traders that are trading through us. And this is the reason why we offer these tools for free, in case you're asking yourself, and you're doing right, because you should always distrust people who offer you something for nothing. So how to use the tools? It's very simple. You sign up to darwinex.com, which is 100% for free, and you link up your strategy either through a bridge or with the investor password on MT4, or using CTrader through the CTrader API. And for that, we will tell you the stuff that we're going to discuss now, which is the risk management tools that I just discussed, telling you how much risk your strategy currently carries and what your optimal trade level leverage should be to make sure that you always stay within your risk appetite. And in addition to that, we will give you additional diagnostics, which are going to tell you how well you're doing on your discipline, your timing, your performance, and how scalable your strategy is. In other words, how much investor capital you could expect to manage with your strategy if you deliver profits.